Hi, this is my third video for corporate finance in the spring. For today's video, we're going to be comparing and contrasting convertible and callable bonds. So what is a bond? A bond is an instrument of indebtedness of the bond issuer to the holder. It's kind of like a security measure, and it obligates the issuer, the one who borrows the money, to pay interest or to repay the debt at a later date to the holder. First, a convertible bond is a type of debt security that can be converted into a predetermined amount of the underlying company's equity at certain times during the bond's life. One of the biggest pros of having a convertible bond is that issuing convertible bonds is one way for companies to minimize negative investor interpretation of corporate actions. So, for example, if an already public company chooses to issue stock, the market usually interprets this as a sign that the company's share price is somewhat overvalued. To avoid this negative interpretation, the company may choose to issue convertible bonds, which bondholders are likely to convert to equity anyway should the company continue to do well. Convertible bonds are a flexible financing option for companies with higher risk and high reward profiles, and they are sometimes referred to as CVs. In comparison, a callable bond, aka a redeemable bond, is a type of bond that allows the issuer of the bond to redeem the bond at some point before the bond reaches its date of maturity. So, the issuer has an option in which it pays for it by offering a higher coupon rate. So, for example, if interest rates drop since the company first issued the bond, the company will likely want to refinance its debt at the lower rate of the interest. This is when the company calls its current bond and reissues them at a lower interest rate. The biggest pro for callable bonds is that callable bonds pay an investor a higher coupon rate than a non-callable bond. Being flexible in the amount and loan length is very important in a callable bond characteristic. Thank you.